Good morning, guys. Just going to give you a few seconds to enter the webinar, and we'll kick things off. Okay, excellent. So look, good morning, afternoon, or evening to all those who've joined. From me and the FP Markets team, thanks so much for taking the time to be with us in this presentation on an introduction to price action. Before I begin, if you'd be so kind as to let me know whether I'm coming across loud and clear and the welcome slide is visible, I would be most appreciative. If you could just let me know in the chat box, just Y or N for yes or no, that would be fantastic. Good afternoon, David from Australia. Wow. Thanks, Mark. Excellent. So now, before kicking off, I'm assuming most here are familiar with price charts and their organization. So what I mean by this is the general framework of a chart, such as the very basics, the X and Y axes, and the basic functions a chart offers. Also, I am hoping most here have a basic understanding of support and resistance. If not, I encourage you to watch our previous presentations, which do cover this. These can be found on the FP Markets YouTube channel, or alternatively on the main website under resources, and you will find the archived webinars there. Okay, so ultimately this webinar is designed for beginners, with a specific focus on price action. Now, price action trading is a discipline that involves making trading decisions from a stripped down, or more commonly referred to on the internet as a naked price chart. It has evolved into a major form of analysis and attracts many traders like me due to its relative simplicity and effectiveness. Just to be clear, this today's presentation is designed, as I've already said, is designed for beginners. So any experienced hands here, this is unlikely to be anything new. Look, as usual, I will repeat this. For any of us here that are wanting a recording of this presentation, this will be available on the FP Markets main website, or alternatively on the FP Markets YouTube channel. Thanks, Philip. Thank you. So, just kicking things over. Look, guys, as in every webinar, I have to quickly run through the disclaimer, so just bear with me. I won't read it all. I'll just read part of it. So the information contained in this material is intended for general advice only. It does not take into account your investment objectives, financial situation, or particular needs. FP Markets has made every effort to ensure the accuracy of the information as at the date of publication. Look, guys, all this really means is this is a presentation, an educational presentation. This does not constitute investment advice. And please do take it as such. So look, apologies for anyone that's a regular here. You're probably bored of me talking about me. But look, so this is just for anyone that's new here, so we all know who's behind the mic. As you can see here, I'm a technical analyst for FP Markets. I have more than 12 years experience in the financial markets. I recently completed the CMT levels 1, 2, and 3. I also have the CFTe qualification that was given to me in 2020. And I also recently enrolled on the CFA program, the Chartered Financial Analyst. I'm a candidate for level 1, and I can tell you it is incredibly intense, this program. For anyone that's interested, please do send me an email, and I will happily tell you about either programs. To be honest, the CMT is more focused towards technical analysis. The Chartered Financial Analyst is more focused on equities and all that good stuff. So yeah, any questions or any inquiries regarding these programs, please do send me an email, or alternatively ask me a question here. Finally, I specialize in price action, Fibonacci, the relative strength index. So for many of us here, we'll know the relative strength index is simply a gauge of price momentum on a chart. So it's measuring the speed of the price change. And finally, I also look at chart psychology. So I look where traders are looking to buy and sell on the chart, and where they traditionally place their stop losses. Okay, so as for the topics, the session's objectives are to define the price action. Here we'll simply be defining what price action is and how most view this vehicle of analysis. So identifying ranging and trending markets. For those with any experience, for those with any experience in price action trading, you'll already likely understand most of what I show in this section, though I consider it 101 stuff and needs to be understood before moving on to more advanced concepts. Next up, we have candlestick analysis, which, as its name implies, is with a specific focus on candlestick structure. Now, candlestick analysis is something we already touched on. I believe it was our introduction to technical analysis where we touched on this. There we looked at two basic configurations. We looked at the hammer and the shooting star. Here we'll revisit those patterns and look at when some traders may consider these as trading opportunities. We'll also highlight a couple more candlestick patterns to be mindful of. Finally, we'll be looking at multi-time frame price action analysis. Now, this is a method of analysis that's becoming popular, but is often misunderstood. So multi-time frame price action analysis is an interesting one for many. Regulars here may remember we briefly touched on the concept during our support and resistance webinar. Looking at how we can apply support and resistance levels to multiple time frames to design some sort of framework. Or direction, if you will. So I often look at the market from a top-down approach, which I will cover very shortly. I look at the the weekly time frame, the daily time frame as my higher time frame gauge, and the H4 and H1 time frames as my shorter-term direction. But do bear in mind, I do also look at other things. I also look at the M5, the 5-minute time frame as an intraday method. But this is something I will cover in future webinars. So to define price action, we really don't need to be fancy. Price action is simply the movement of price, nothing more. This could be the movement of a currency pair, a stock or equity, a bond, a cryptocurrency. It really does not matter. The point is we're looking at instruments, price movements plotted over time. I've been involved in technical analysis for more than, as I've already said, for more than a decade now. And from my experience, I personally believe price action trading to be one of the more superior systems of analyzing the market, as the majority of, as I'm sure you're aware, the majority of technical indicators are calculated based off price action. They are actually a derivative of price. So I just feel that price action gets me closer to the market, if you will. This is not to, of course, this is not to cloud technical indicators, as they certainly have use. In fact, I know a number of traders that actually combine price action and technical indicators to form trading strategies. I even use the RSI because it helps me gauge, as I said, price momentum. I can see it on the chart, I can see it on the candles, but it's so much easier to just look at one line and to know when we're overbought or oversold, and when momentum's slowing to the upside or slowing to the downside. The RSI just fits that bill for me. So on the slide, we have the Euro Pound daily chart. This is a naked chart it's completely free of indicators, and no technical tools are applied. This is price action. Now, this is what we're looking at, and it is something I'm pretty much obsessed with. The psychology of a chart has always fascinated me to this day. With the stories it shows, it actually tells you a story of what's happening, where traders commonly buy and sell and place their stops. And this is something more experienced traders look at. So for instance, just as a quick example, we know here we have a clear support formed here. We know below this area, here, there will be sell stops in the form of protective stop loss orders and sell stops in the form of breakout sellers. Because once we break this support here, let me just write this, let me just annotate this so it's easier for us to look at. There we go. So here we have, just excuse my drawing here. So we have support here, and below this area, we will have stop losses, both from, as I said, both from those looking to protect their position, from those that went long at this point. Look, price did try to go higher, but then ultimately pushed lower, took out those stops, and then continued lower. So we have those stops from traders attempting to fade this support, but we also have stops below here called sell stops, again, that are primarily used by breakout sellers. So what happens is, once price trips that order, we are now in a sell position. So what they're looking at is to take advantage of any strong move seen through this support. Sorry guys, I've gone a bit overboard there. I didn't really, this is a basic introduction. I shouldn't have really gone that deep. But look, that's mainly what I'm talking about when I'm looking at the chart psychology. So let me just remove this, remove these drawings. Okay, right. So next up, we have the Euro Pound, again, daily chart, and the Bitcoin daily chart. So these charts were saved a while ago. Don't get excited about the Bitcoin price. But look, the question I want to ask is, would you be able to tell the difference if we blocked out the X and Y axes? You wouldn't. Not only would it be impossible, you would not be able to tell which time frame you're working with that price action represents. These charts here could just as easily be the 5-minute chart. They could just as easily be the monthly chart. So really, the general idea of price action is pretty much the same for each market, whether you're looking at the M5 chart or the M1 chart. Of course, the M5 chart will be faster. It will develop candles a lot quicker. Of course, that's obvious. But price action is going to be the same, irrespective of the time frame you're looking at. That's the main point I really want to get across from this slide here. So price action is almost universal, irrespective of the time frame we're looking at. So ranging and trending markets. For those with experience in price action trading, you'll already likely understand part of the presentation, as it's essentially 101 stuff. But for the newer traders, this must be understood. So in our previous technical analysis webinar, we introduced the concept of trend. So for those who did not watch the TA presentation, I'll quickly run over the basics of what we looked at, so we're all on the same page. So on the slide, we have what's known as an uptrend. Okay, you can clearly see it's a trend that's facing higher, that's constructed through a series of higher highs and higher lows. This is what makes up the concept of an upward trend or a trending market to the upside. It's a relatively simple configuration, as you can see, but look, do bear in mind that the trends are not always as clear as this, obviously not as clear as this on the live charts. And again, look, very simply, the next slide here is the reverse of an uptrend. So this is a downtrend, and this is drawn up through a series, as you can see, of lower highs and lower lows. So we have a lower high. It's very, if you think about it logically, it's very, very simple. Where's my cursor? We have a lower high, we have a lower high, and we have a lower high. And following this, we have subsequent lower lows here. Okay, this is the basic definition of a trend. But look, for those interested in trend structure, I would encourage you to look at Dow theory. He states that that trends move in 3 phases. So we have let me just go back to the previous slide. We have the primary trend, the primary uptrend. As you can see, imagine this is the major trend on the weekly time frame. Okay, So remember, the market is fractal. And this is basically what I believe he was trying to get across. He did get across. Just bear in mind, this was formulated from the texts of Charles Henry Dow through a book, I believe, from a gentleman named Robert Ray, I think. And he defined these trends as, so look, trends are defined in 3 phases. So we have the primary trend, which, as you can see, is the major weekly trend, shall we say. And then we have the secondary trend, which consists of the corrections within the primary trend. Okay, so we have the corrections here, the corrections here, and the corrections here. As you can see, the corrections go against the immediate primary trend. So this is a secondary correction at this point here, a secondary correction at this point here. So in terms of the secondary corrections within a primary uptrend, you will have a downtrend. Okay, it is when price turns higher within the secondary uptrend, you can find high probability trend following opportunities, because the secondary trend is now in unison with the primary uptrend. Then we also have the third phase, which is the minor fluctuations. Look, I'm not really going to go too much into that, but that's really the intraday fluctuations. And according to the text I've read, these do not really have much of an effect on the overall trend, but they are all connected because the market is fractal. So within the secondary trend lower, you will have minor uptrends in the minor trend, right? So there will be uptrends here, there will be minor pullbacks, so there will be uptrends. It all depends on the time frame you're looking at. Okay, so let me just go back to that chart. So most of us have probably heard of the old adage, the trend is your friend. And as I highlighted in the previous presentation, it really is true. And I emphasize the words if. It really is true if you manage to time the trend correctly and have the patience and risk management to ride the trend out. Now, that's a big if, of course. A lot of traders, they have difficulty timing the trend, which I understand. They also have difficulty holding on to trades. It really gets to me when traders say the profits will take care of themselves. No, they will not. They will not take care of themselves. You have to take care of them because your emotions are playing into it as well. As prices trend, if we go back to this slide here, just to point this out, as prices trending higher, the fear of price pulling back and eroding those gains is there, and it's clear, and it's palatable. So gains do not take care of themselves. You have to take care of those. It's still a huge part of your trading approach, your trade management, how you actually control your take profits. Discipline is required for that as well, as much as controlling the loss. So if you manage to enter near the beginning of a move, which, as I'm sure most of us here are aware, is difficult, and are able to catch a large portion of the trend, this is where you make the money. So you're looking at so we have a section here. So the trend begins here. Not many people will be in at this point here. You will have some getting in on this reversal, this pullback here, a correction, sorry. And they'll be looking for dip buying opportunities. So there'll be traders coming in here. This is a very early time to be in the trend and a fantastic profit opportunity. So we're looking to catch the meat, if you will, a relatively large portion of the trend. Is highly unlikely. It's almost impossible. You're going to get in at not almost, I think it is impossible unless you're very lucky, at the bottom of a trend, and you're going to exit at the top of a trend. It's almost impossible, I would say. Right. So look, fear and greed. I just want to touch on this before we move on. How many of us are actually capable of riding out the trend? There's not many of us here, I believe, that have the discipline or the experience to ride out a trend. I'm not saying it cannot be done. I'm not saying it is not done. It is by very successful traders. What I mean here is fear and greed, and it's the two drivers that really affect our daily lives, which carry over to our trading. Actually, fear and greed are often labeled, are often identified as the main drivers of the markets. So look, fear is often observed in situations such as reluctance to enter a trade, or even the closing of a winning trade prematurely. It's very similar to what I was saying a few seconds ago. When I say fear of a reluctance to enter a trade, I'm sure we've all been there. We've had a consecutive losses, and the fear is there of entering a trade because the fear of loss, right? It's the fear of another losing trade, and it's painful for a lot of us. I do understand that. We also have something called revenge trading, which is when a trader attempts to win back losses by entering larger and often riskier, entering into a larger and often riskier trade. Now, this type of trading is driven by fear and frustration, and is a vicious cycle, and can have devastating consequences. I have experience with this when I first began trading in my first few years, actually. You have a loss and another loss and then another loss, and it's unfortunately human to want to recoup those losses, to repair that damage, if you will, and make yourself feel better again. Look, greed, on the other hand, is situations when say traders add more capital to winning trades or over leverage. Look, this is fine if your system allows for this and has been tested, which is very commonly referred to as pyramiding. So you're adding to a winning position. I do encourage that if it's been tested. You're working with a back-tested system, and you're adhering to, obviously, your risk management principles. But not if you're simply adding to positions on a whim, as that can end very, very badly. Risk is increased, especially if we see, look, a perfect example is the oil market, right? So the oil market has been raging this week. This week, imagine if you pyramided, you added to your position. Now look at the price. I haven't checked the oil prices this morning, but I know that yesterday was a terrible day for the oil markets, the WTI market and Brent crude. A terrible day. We was down by 12% and 13%, I think, for Brent. Look, I hope you guys understand what I mean here. And look, again, apologies for deviating here slightly. And I hope I have not confused any newer traders. Look, the idea here is to understand that trending price structure and recognizing the basic higher highs and higher lows represent a trending market. And for a downtrend market, recognizing that lower highs and consecutive lower lows recognize a downtrending market. Okay. Yeah, so David's made a comment here. I'm not sure if you guys can see this, but when I set up a method of trading. I tested the method for 12 months to get to test and get confidence in the method. I really use weekly charts. I think that was really, or usually. Look, David, that's fantastic. That is something I would highly recommend. You probably would not be surprised, but there's so many traders that do not backtest their systems. It's something that I really enjoy, actually. But a lot of people find it difficult because they want to get in the market and make money, and that's where the mistakes come, right? You need the statistics to back up your trading strategy. Without those statistics, when things do go wrong and you do get those consecutive losses, this is when the emotions will really kick in and will really start affecting your trading ability, your trading mindset. So with that in mind, backtesting is incredibly important and something I would highly recommend. And as David quite rightly says, it can save a lot of money. It certainly can. It can save from wiping out your account. I'm pretty sure some of us here have wiped out our account, and I'm pretty sure they were not working with a fully backtested system and approach. But look, something else I will recommend is the Trading Psychology, a book I wholeheartedly recommend to all traders regarding the trading mindset and trading psychology. Is a book written by Mark Douglas. It's Trading in the Zone. It's a fantastic book. Just search on YouTube. There's plenty of information about this. The late Mark Douglas. Fantastic book. Fantastic audio files. Fantastic videos on YouTube. Certainly, highly recommend if you're interested in expanding your trading knowledge. So, continuing on, not only can we use price action to decipher trend, we also use price action to determine trading ranges, or more commonly referred to as consolidations. This is one of the, as you can see here, this is one of the simplest chart patterns and is easily recognizable, and it's formed by a support, as you can see here, and a resistance level. In order to qualify a trading range, I look for textbooks, I believe, also look for price to at least touch the extreme levels at least twice before defining a range. Similar to if you're looking at trend line. So let me just go back to the previous slides here. If you're looking at a trend line, so I would say 0.1, 0.2. So from here to here is what I would use to determine a trend line support. Some will want the third point in contact. Fine. That's if that makes you feel more comfortable in your trading, that's absolutely fine. So on to the ranges again. Look, as you can see here, very basically, price is bounded by two limits until the unit, until the currency pair or stock or whatever breaks out in either direction. Actually, breakout trading is a common approach around ranges, and especially in trending environments. So if you imagine that prices has been trending higher and we enter a ranging environment, this is very, very common, by the way. And we enter a ranging environment and we break out to the upside. This is what a lot of traders will take on as confirmation of the range. Now, I do have a great example on the dollar yen currently of this playing out. Of not playing out because it's not really rallied far, but it's something I highlighted in my market analysis, which was yesterday. It's something I will go over very shortly. Okay, so yep, we've covered most of the things on here. Look, this is just really emphasizing the break retest structure from a range. As you can see here, we have the range formed at this point here. At this point here, we have 2 points at this location, 2 points here. So the range is nice and healthy, and we get a breakout to the upside. Okay, we have the break and a retest. Now, as price retests this area, I have a perfect example on the dollar yen of this, just to remind you. We retest this area and we hold and we develop a support. Now, you will find a lot of traders then drill into lower time frames here to analyze the lower time frame price action to find a profitable, potentially profitable setup to go long. Whoops, I didn't mean to do that. Sorry. And the same can be said to the downside. If a break and retest occurs to the downside, we can then look for shorting opportunities on the retest. Just to highlight that the retest is one of the filters, if you will. So breakouts within ranges, you will find that whipsaw price. So you will find, let me just draw this on so we know where we are. Bear with me. So at this point here, we have a range. We have 2 points there, 2 points here. Okay. And at this point here, price whipsaws above this range. Okay, range resistance, and then comes back. We've all seen this. We've all had stops taken at this point here. Okay, so this is what's called a bull trap, and it will make sense once I explain. So a bull trap is above here, we have breakout buyers ready to pounce as here, right? So we have buyers ready to come into the market at this point here, at this point here. But what happens is price slams back into the range and effectively traps those breakout buyers here. So this is why we look for filters such as this one here. This is a very basic filter. We look for a retest of the range rather than buying on the direct break or a close outside of the range. Okay, so we give price a little bit of time to prove itself, and retest the structure. You can also use moving averages at this point as filters. So if once price comes above a moving average at this point here, that's another filter we can use. There's a number of filters. I won't go into them right now, but there are a number of filters you can use to help reduce the number of whipsaws. Okay. Right. Your chart is covering the chart. Okay, David, I'm not sure what you mean. Do you mean the previous, this one? Your image is covering the chart. Sorry, your image is covering the chart. Yeah, I'm not sure. There wasn't a chart on there, David. This is the next chart for the next slide. So look, let me just continue quickly, and then we'll get on to the live chart. So look, drawn examples are rarely represent real life trading. So the drawn examples are the ones I just developed on PowerPoint. So here's the British pound against the US dollar for the daily chart, which shows. Look, guys, these are not live charts. These are charts formed in the past. So look, very clearly here we have a trend formed at this point here. These are the pandemic lows, the COVID pandemic lows at this point here. So we have a low, a higher high, sorry, a high, higher low, higher high, higher low, higher high, higher low. So as you can see, consecutive higher lows, consecutive higher highs. Now it's at this point here, things get a little bit muddied. Now, for me personally, I would be looking at this as the next higher high, next higher low, then the next higher high, and the next higher low, because these are the most stand out to me. The dollar CAD chart very simply shows the opposite of that. Again, on the daily time frame, shows the opposite of the pound dollar uptrend. So again, we have this is the high set during the pandemic at the beginning of the pandemic, so March 2020. So we have a low high, a lower low, a lower high, a lower low, lower high, and consecutive lower lows and lower highs. Okay, so we look to define trends in that sense. Now, for any newer traders present, I would encourage you to stick to the, if you will, the primary swings, instead of going into the smaller, these smaller swings. I mean, look, if you feel comfortable, go for it. But if not, I would always stick, for any newer traders, just stick to the major trends, and that will help you a lot. But look, you can also use moving averages to define the trend. If price is below the moving average, we're in a downtrend. If two moving averages cross each other to the, if shorter term moving average crosses below the longer term moving average, then you're in a downtrend. So there's different ways of defining a trend. You can also use the ADX indicator. Is another way of defining trend. Okay. So, and finally, here's a H4 chart of the euro dollar, and this shows a ranging market. Look, and this really highlights the points I was making regarding a whipsaw. These were nasty moves, and this would have caused a lot of damage to a lot of traders. Just to help, just as a point of reference, I've highlighted the pre-drawn range, and it's very similar to this, but as you can see, it's not. Real life is very different. Okay, it's rare to see a range formed to the pip, as you can see on the pre-drawn example. There's always going to be whipsaws, as you can see here. But as long as it's relatively obvious, then the range can be drawn, in my opinion. So let's just quickly throw things over to the candlestick analysis. We looked at two basic candlestick configurations in the previous webinars, the hammer and the shooting star. So the hammer is considered a bullish signal formed from by a long lower shadow, and a real body that closes near the upper range of the formation. And just to note that the candle's lower shadow is needs to be at least twice the size of the candle real body. Now, in terms of any upper shadows, it's best if we don't have any, but it's very it's very rare that we have that. So there is usually an upper shadow at this point here. Also, it's vital to recognize that candle body color is not irrelevant in according to the Steve Neeson, who's considered the I would say father of Western candlestick analysis. He was the one that introduced it to the Western world. So yes, he states that the candle's body color is irrelevant. So in terms of entry, traders often employ what's known as buy stop orders for hammer patterns. So a buy stop order is used to buy at a price that's above market price. So assume price is trading down here, and we want to enter long at this point here. We can look at initiating a buy stop order. And look, this is triggered when price touches this order. So we remember, guys, we buy at the ask and we sell at the bid. So when the ask price touches this line, we are then in a buy position. This is similar to the protective stop loss order. Look, commonly traders place their protective stop loss orders below the lower shadow of the pattern. Would I recommend this at times? Yes, I guess. But I would always look at the structure to the left of price if we have support or a demand area or a prime support area. That is what I would be looking for to place my stops below, because quite often you will see price whipsaw below this low and then continue to the upside. Look, this is a sell stop order, of course. So once or if price turns out unfavorably, then we will be you will sell to close. Everything we've just highlighted here really is the same for the shooting star. It's only reversed and therefore represents a bearish signal. Now, just to be clear, these are not the only candlestick configurations that traders employ. I'm pretty sure most of us are aware of this. In fact, there are many. That we also have bullish and bearish engulfing patterns. Now, look, bullish and bearish engulfing patterns are often confused. Bullish and bearish engulfing patterns are only involve the candle's real body. Okay, so we don't focus on the range. We do not focus on the highs or lows. If you're focusing on the highs and lows, you're looking at a bullish or bearish outside reversal. This can be all read in a number of candlestick books. Most of mine was learned from the CMT actually, but most of the work for the CMT was done by Steve Neeson, who is actually a CMT as well. Yeah, so that's really it in terms of the candlesticks. Really, there's not much else I can really say. If you want to look into this further, please do go ahead and look at Steve Neeson's book on Japanese candlestick analysis. He highlights how we can use candlesticks and things like that. Okay, so this slide here will help to help demonstrate the how to use candlestick analysis with price structure. So as you can see, we have the range here. This was the range from the prior chart, and we also have a Quasimodo resistance at this point here, taken from the left shoulder, which comes in around the 1088 region. As you can see, we did get a mild bounce from this area, but we did break above here. We also, I believe, we broke above the peak at this point here, the Quasimodo peak, and subsequently retested this level as support. Now, that's a very, very common setup that I would highly encourage most traders to look at. So look, the point I want to get across here is we have a resistance at this point here. You can clearly see resistance. Sellers were coming in. Sellers were clearly attracted to this area, probably more attracted to this decision point at this point here. Especially for this move here. But that later we break above to the upside. We react from the range resistance, and within the range resistance, within the overall range, we have a moderate support resistance turn support. And if you can see, I hope you can see, we have a hammer candle formed at this point here. Now, usually I like to see the hammer candles almost on an individual but isolated. Here we're not so isolated. It's accompanied by a number of surrounding candles. But look, really, we have a hammer candle here that's followed up with a bullish candle. And, this, look, guys, this is a cherry picked example. I'm not saying I would trade like this every time, of course, but things like this can help forecast weakness within the range. So, for instance, we know this range is pretty much even. So we've got even sellers and even buyers. But if we see a resistance turn support form and price begin reacting from this support midway through the range, this tells us, this emphasizes the point that that sellers are weak within the range, and we could potentially break out to the upside, which we did in this case. Yes, so I think that's really all. Okay, so next up we have the final point of the presentation, and now this is multi-time frame analysis. Let me just check the questions really quickly. Yes, Maggie. No, Maggie. We've had a bit of we've been moving the times around. Sorry about that. We start at 9 a.m. GMT going forward. Sorry about that, Maggie. Look, Shabu, I'm sorry if I pronounced your name wrong. I'll get to that question regarding price action in a minute. Yep, Maggie, you can. So there's a question regarding Mark Douglas's book. Yep, really opened your eyes. Yeah, I remember, Maggie. I remember you saying. Yeah, please do email me the questions, any questions you have regarding the cycle trading mindset, and I'll happily get back to you as soon as I possibly can. All right, cool. So look, multi-time frame analysis. So as I said at the beginning of the webinar, multi-time frame analysis is an interesting one, and regulars will likely remember me touching on this concept during the support and resistance webinar. So look, multi-time frame analysis for me follows a top-down approach and allows traders to gauge the longer-term trend while spotting ideal entries on the lower time frame chart. This is real common sense here. So we see higher time frame support in play, and if we see a harmony, a convergence of the lower time frames along with the higher time frames, we have a high probability technical trading opportunity. Now, the rule of thumb is to work with a 1-to-4 ratio for the time frame. So as you can see here, we have the euro dollar H4 daily time frame, monthly time frame, and H1 time frame. Now, the reason behind the 1-to-4 ratio is to uncover smaller movements in price for well-timed entries that are ultimately in line with the bigger picture. So if you're viewing the H1 chart for trend direction as a short-term day trader, you may choose the 15-minute time frame to hone in on entries. This is a 1-to-4 ratio. Now, guys, just to be clear, you do not have to follow this ratio. I'm not sure where this was derived, but it does make sense for me. Do I follow it to the T? No, I do not, because obviously I look at no, I do not follow it. No, I think with experience, you understand which time frames suit you more, to be honest. But look, guys, so there's not really much I really want to add on this chart here. So just bear with me. I'm going to switch over to the main charts, and we'll talk about some multi-time frame price action here. Now, this is really quickly. This is the dollar yen. Let me just remove my crosshairs. So this is the dollar yen, right? So look, just to be clear, I know this is an introductory webinar, but I will be talking about more advanced concepts because it forms part of my daily markets analysis for FP markets. So please do bear with me. The point I wanted to get across was this consolidation on this is the H4 time frame. As you can see, this H4 time frame consolidation between 114.72, 115.78. As you can see, we smacked right into that resistance, and we also rebounded from support. Now, what happened is we broke out to the upside, and we have retested the resistance as support, and it held. Now, how did I know that would potentially happen? How did I know a breakout would potentially happen to the upside? It all comes from the higher time frames, right? So this is the weekly time frame. As you can see, we have been trending higher. Remember, a trend is defined by higher highs, higher lows, higher highs, higher lows, consecutive higher highs and higher lows. we are in an uptrend on the dollar yen. And even for the longer term, remember the primary trend? We are in a longer term primary trend. But look, this is the key thing here. Do you remember what I was saying about primary trend and secondary trend? We have a primary trend at this point here. This is a correction, a secondary correction. Now, within this correction, we're looking at really clear bullish price action within this correction. So at the time price crossed above this descending resistance, okay, this is a descending. This is not a trend line, guys, because it does not highlight a trend per se, because it intersects through price. So this is a descending resistance, if you will. We broke above that descending resistance and we retested that area and we held higher. So this is, look, this is key confirmation for me that we are in a strong dollar yen market right now. The 1.272% Fibonacci projection, as you can see here at 116.09, has remained a headwind for the dollar yen. This is the weekly time frame, guys. But after we broke out of this area, I knew we had room to move to at least the 116 figure. Let me just highlight that on the H1 time frame. I also knew there was room to move higher on the daily time frame. We have Quasimodo resistance at 116.33. So I knew there was some room to move, right? So after we broke out of the consolidation and retested and held as support, I knew there was some room to move higher. And quite as expected, we have connected with the weekly time frames Fibonacci resistance and have reacted. Now, ultimately, I am looking for price to continue higher to the daily Quasimodo resistance. Now, by combining, for any pattern traders here, we also have an ascending triangle formation forming at these points here. Look, if we do break out to the upside here, this is a strong continuation signal. Okay, so look, by breaking out of the range on its own, it's very difficult to tell, but with including the overall technical picture, I could with a reasonably high probability tell that further buying was likely on the cards. Now, any questions about this chart, please do let me know. None for now, I believe. Okay, Angelo, you say you can't hear me. That's a shame. I think everybody else can hear me. Any issues, they would have let me know. No, there might be an issue on your side, Angelo. I apologize for that. Just really quickly, so look onto the euro dollar. Again, multi-time frame analysis, guys. Let me remove my crosshairs. So on the weekly time frame, look, we are in a downtrend on the weekly time frame. We have broken this trendline support term resistance. We also took out these lows and we also retested this resistance area at 1473, 1583. In addition to this, we also jumped through support at 1174. So this all tells me that we are in a longer term, a weekly downtrend for now. And any pullback on the bigger picture would be considered a sell on rally scenario. Now, with that being said, on the daily time frame, we do have a descending support term resistance and a 38.2% Fibonacci retracement at 1075, which welcomed price in yesterday. As you can see, we do have some selling interest at this point here, but would I bet my house on this? No, for sure, because I do not consider this strong resistance, to be honest. I would much prefer this resistance up at this point here at 1224. Now, let me just switch my crosshairs back on. As you can see, this resistance, this daily resistance at 1224 also coincides with the weekly time frames resistance in line with the overall trend. So not only do we have weekly resistance at 1174, daily resistance at 1224, as well as the overall trend facing lower. Okay, so this resistance at 1224 is a clearer area of resistance to me. So do I expect this area to hold? Quite possibly not, to be honest. That we may see the sellers try to come in here and form a small candle, but ultimately I do expect we are heading for this resistance at 1224 on the euro dollar. Now, again, guys, you can see I've formed confluence between daily resistance and weekly resistance. So it's always key to understand where you are on the overall picture from different time frames, different structure. Now on the H4 time frame, we can also see we have it was this decision point I showed interest in. So it's this decision. Sorry, guys, I've been speaking a lot. Decision point at 12:34, 11.95. This is on the H4 time frame. Now, what really attracted me to this was the trend line resistance convergence at this point here. Now, should we jump above this area? This is somewhere I would be looking for sellers to make an entrance, not only because it's a reasonably strong area on the H4 time frame, it's also connected closely with the weekly resistance and the daily, as you can see, the daily resistance at 12.24. I think that actually holds the, yes, so look, the daily resistance is actually intersecting with that area. So these are all points you need to bear in mind. So what you're looking for is points of confluence on a chart. So you're looking at where technical tools converge and offer you a high probability trading opportunity. Price usually trades in a direction of the path of least resistance, right? So if you have exceptional higher time frame resistance, you know, in addition to shorter term, lower time frame structure, then you would, you know, it's a high probability trading opportunity, in my opinion. Now, I've purposely left the H1 time frame out for now because I think this really demonstrates the point I'm trying to get across. Okay, that's excellent. Oh, thanks, David. Thanks for letting me know. Okay, Angelo, just to answer your question, is it possible to watch the a recording of the session? Yes, I did say this at the beginning of the presentation. A recording will be available. It will be put up on YouTube and also on the main FP Markets website under resources. Under resources, yeah, and you'll find that you'll find the tab webinar that you can click on. Just really quickly, is there anything going on the look, guys? If you have any setups or anything like that that really encompasses the multi-time frame approach, do let me know and we'll check it out really quickly. There's not much really going on here. I mean, for anyone that looks at chart patterns, we do have a potential double bottom on the daily time frame for the Aussie dollar. As you can see, the double bottom formed within this decision point at 69.64, 70.40, and we have broken the pattern's neckline. Okay, by breaking above here, this puts a potential profit objective of 76.60 in the crosshairs. But that would entail, of course, breaking this trend line resistance. So look, guys, look, the main point here is to really not just focus on one time frame for your trading. Although I do with one setup I use, although I do, I have to admit that. But I always try to incorporate higher time frame structure, especially when I'm looking at the H1 and H4 time frames for trading opportunities. So that's really the key point here is, I know it's confusing for newer traders. I remember when I first began trading, I would get the weekly chart. So this is the weekly chart of the Aussie dollar. I would use just one chart to label all my resistances, label all my support and resistances and things like that. And it would become almost a what's the word I'm looking for? Almost like a pizza, if you will. It would be so packed with support and resistances, I just could not function. So hence why I split the charts, and it's much better from my trading perspective. So Maggie's asked a question: how long are your trades held for? Usually, look, as I said, I do look at different methods. The M5 setup I use, which I consider my best setup, to be honest. It's very complex, though. I say complex. It's not complex. It's just it took me a long time to fully understand because it really incorporates the chart psychology of things. Anyway, so in terms of my M5 trades, that could be it could be 10 minutes. That could be an hour. I have set profit objectives for that. I have set stop losses for that. So my risk and reward are covered. And it could last, as I said, from 5 minutes to an hour to maybe 2 hours, to maybe even all day. If price overcomes my first profit objective and continues to rally, I will hold it and trail the position. Some of my best trades have been when I've trailed the position. You know, we get out for I know most of us we we look for a 2-to-1 trade or 2-to-1 trade on our risk reward, right? I get that. And if you can do that consistently, that's absolutely fantastic. But if you get a 4-to-1 or a 5-to-1 trade, it really, really helps when you do get those consecutive losing trades. But do bear in mind, if you're attempting to approach trades with higher risk reward, your win ratio will, I think, decline as well. So yeah, with the longer term charts, Maggie, I think it's more, it can be days. You know, I don't really like holding long term, to be honest, especially during the conditions we're seeing right now with gaps forming and things like that. It's really not something I'm comfortable with. Holding positions overnight, anything can happen overnight at the moment, and it's just not worth my just not worth a sleepless night, and it's just really not worth it, in my opinion, unless you're, you know, yeah, for me it's just really not worth it. Okay, so if I just switch back to the okay guys, I hope you can see the slides again. Yeah, I bet you did, Maggie. I've had plenty of sleepless nights regarding trades, and it's just not the way to trade, right? It's just not the way to trade. If you're having sleepless nights about your trade, you're either risking too much or you're not confident enough in your setup. Look, backtesting is key, guys. You really should spend the time to backtest your. I know looking at charts and I know looking at patterns is fun, but it's like any other business. We need to do our preparation to succeed. Without that preparation, you're essentially gambling. In my humble opinion, I'm sorry if I've offended anyone by saying that, but without the correct preparation, you're essentially gambling. In my opinion, there's I would not. So backtesting. So backtesting is where you take a pattern or an approach and you test it on prior data. Now, there's different types of testing. Look for a discretionary based system, it's very difficult to backtest fully, of course, because there's emotions involved. But with a non-discretionary system, you know, algorithmic systems, this is where you can really hone in on you can really perform a really in-depth backtest, because there's no emotion involved and it's all done by computers. But you know, primarily I'm a discretionary based trader, so that's really off the table for me. Okay, guys, any other questions that I missed? Was there a question? Oh yes, in a war situation like this was from Shabu. In a war situation like we have now, how do we analyze price action? That's a very, very good question. Yeah, as best as you can, in my opinion. I'm sticking to my methods. I've not changed. I think you can alter your, because of the volatility, you can alter your stop loss. You can use the ATR more, I guess, the average true range, to define your stops. You know, with FX, it's not really had that much of a big impact, to be honest, from the conflict between Russia and Ukraine. Yeah, so look, yeah, thanks, David. Thanks for coming along. Excellent. So for me personally, I would always look for, I would always try to, yeah, adapt to the volatility as best as I can. Shabu, I'm sorry if I've pronounced your name incorrectly. Okay, look, just to wrap up, guys, you know, look, thank you very much for your time today. It's highly, I really do appreciate it. As always, if there are any specific topics you wish the team here to talk about, please look, send me an email, send in your suggestions. I do reply as quickly as I possibly can, and the support team also will as well. Look, comments and feedback, please, to Market Analyst at fpmarkets.com. This is the research team's email. Alternatively, look, fire an email over to our support team at support@fpmarkets.com. But look, if it's anything about the webinar, all they're going to do is ask me or ask the research another colleague to reply. So it's probably quicker if you just use the Market Analyst at fpmarkets.com if you're referring to anything in the webinar. Look, upcoming webinars to be on the lookout for. The importance of a trading plan. I'm going to go over the basics on the 17th of March. Then we'll be deep diving into Fibonacci trading. Look, I highly recommend this webinar. Many traders label Fibonacci structure incorrectly. And what I intend to do is hopefully clear some of this confusion on the 24th of March. Again, look, guys, times are 9 a.m. GMT, okay, going forward. Also, look, as I say in every webinar, please do register for our FP Markets Telegram channel to get instant updates. The sign up tab can be found at the lower left part of the FP Markets website. Let me just check, see if there's any other questions. Thanks, Eddie, from Melbourne. Wow, we've got a very global audience. You're welcome, RY. That's fantastic. You're welcome, Mark. Okay, guys, that's it from me. So, look, I hope this has been informative. As I said, any questions, I'm here to help, guys. Please do fire an email across. And look, yeah, fantastic. I'll catch you on the next webinar. Thank you, guys.